Hello everyone, welcome to Demand Supply Trading Practical session number 42 for the year 2025. Myself, Srijit Kakar, and today is Sunday, 2nd of November 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, we also update you when these live sessions are scheduled. So in case you have still not joined this channel and you wish to join it, there are a few different ways you can do it. The first one is you can scan the QR code which is on your screen. Second, if you go to the description of this video, you will be able to find the direct link. You can click on that link and you can join this channel. And thirdly, when you visit our website, which is surjitkakar.com, or you can use the short URL, which is sk.coach. So once you're on our website, just give me a second, let me quickly show you. Right. So once you're on you are on our website, you can just scroll down on any of the pages. And in the footer section, you'll be able to find this join Telegram channel banner. And just next to it, you have the join now button. You can click on this join now button to be the part of this Telegram channel and always be updated with content related to demand supply trading methodology. Plus, if you also have some promotions coming up, we also update you regarding those promotions on that channel itself. All right. Moving forward, so today's session is practical application of demand supply trading methodology. So our demand supply course, which used to be a paid course, is now available as a 100% free course. Now, once you go through the course content, you basically learn the methodology theoretically, right? What is demand supply, how the zones needs to be identified, how do we qualify them, how do we do the multiple time frame analysis, how do we apply the boosters, right? So all those things are theoretically covered when you go through the course. But what happens is, unless and until we see some practical examples, at times we don't get a very good understanding of how it has to be applied. And that is what we do in these practical sessions. So almost every other weekend, I do a practical session where we take some real life examples. And to those real life examples, we apply the complete methodology so that you can understand how to plan trades very mechanically and rule based. Now, the best part about these practical sessions is that we are not analyzing something which has already happened, because like I always say, a move which has already happened, it's very easy to justify it. You can use a number of indicators, a number of oscillators, maybe price action, and you can justify that move because now it has already happened. But the real challenge is when you have to do the analysis in advance, and that is what we do in these sessions. We do not analyze what has already happened. We analyze what can happen in the future. And that is the beauty of demand supply methodology, that you can pre-plan the areas where you would like to be buyers and sellers. And whenever prices, they revisit those areas of demand and supply sometime in the future, that is the time these trades, they get triggered. And just because I'm sharing these analysis in advance does not mean that I share these analysis and then we forget about it. Whatever analysis I share with you, when they get triggered in the future, we also review them. So that helps you see both the before as well as the after. And once you're seeing the both the before as well as the after, that helps you build confidence in the methodology. Plus, at the end of the session, I also take your questions, queries. So in case you have any questions, queries related to trading, you can always put it in the comments, not in the comments, in the chat box. And at the end of the session, I'll take your questions, queries, and I'll try to answer all the questions, queries before we end the session. Right. So to be comfortable with these sessions, there are few prerequisites. And if you will complete these prerequisites, these sessions will be much more easier on you. So let's understand what these prerequisites are. So the very first one is the Trading Essentials course. Now, it is optional for someone who already has a very good trading background. However, I would recommend, irrespective of what your trading background is, everyone should start with the Trading Essentials course. But yes, if you have a lot of experience with trading, you have been trading for a number of years, you want to skip the Trading Essentials course, that can definitely be done. But yes, those of you who want to start with the Trading Essentials, how do we access it? Very simple. Once you're on our website, you can see under the services tab, we have the option that says courses. You will click on courses. And here you can see the very first one is Trading Essentials. You'll click on it. Now, the course is available in two languages, English and Hindi. So whatever language you're comfortable with, just click on that button and you will get immediate access to the course content. No signups, no registration required. The course is laid out for you in a systematic way, like it's a playlist. So go through all the lessons, lesson 1, lesson 2, lesson 3. So once you're done with all the lessons, that basically covers your trading essentials course. Now, once you're done with the trading essentials course, the next one is the demand supply trading course. Now, how do we access the demand supply trading course? It's the same process. Under services, you have the option for courses. Click on courses, and here you can see the next one is the demand supply trading. So click on this, and again, this course is also available in two languages, English and Hindi. So whatever language you're comfortable with, click on that. You'll get immediate access, no signups, no registration required. Plus, what also happens is, see, when you will go through these lessons, you will learn the methodology theoretically. And like I was talking about that, yes, theory definitely helps in understand the process, but unless and until you see the practical application, at times you don't get a very good understanding of how it has to be implemented. And that is the reason I do these practical sessions. So all these practical sessions that I take, they are also recorded, and you can access the recordings of the previous sessions. So you can see at the bottom you have this third button which says practical sessions. Once you click on it, you can access the practical sessions in English or Hindi, whatever language you're comfortable with. And the current archive of these practical sessions is almost getting close to 2 years of recording. So you have a lot of resources available to you. The more number of sessions you will see, the better you will start having the understanding of the demand supply trading methodology. All right, so coming back to the prerequisites, so we have already talked about the trading essentials. We have talked about the demand supply trading course. Now, during the live session, you will see that I use two documents, which is the rule book and the flow chart, to help plan trades in a very mechanical and rule-based way. Now, how do you get access to these two documents? Again, it's very simple. On our website, you can see under services, you have the option for downloads. Click on downloads. And you can see you have your rulebook and the flow chart. So you can download the rulebook and the flow chart from here. So this is the rulebook, and this is the flow chart. So just a second. Now, how do we use these documents? We will talk about it during the session. In fact, if you have gone through some of the practical sessions, you would have already experienced it. But almost every practical session, I use these two documents to plan trades very mechanically and rule-based. All right, so now that we are done with the prerequisites, so we can get started with our analysis for today. But before we start with our today's analysis, we do have a few examples which were getting carried forward from the previous session, and we also have some examples which got triggered during the week, right? So let's review these examples, and once we are done with the review, then we'll start with our analysis for today. So just give me a minute. Let me bring up these examples. It will just take me a few seconds. All right. So the first one is session number 37. This one is getting carried forward. We did the analysis on the 28th of September, and the prices came into the zone on the 8th of October. This was a type 1 trade for us. You can see that, the last few sessions we have been reviewing it. We have been trading inside of the zone for quite a while. Yes, prices did give a small bounce, but it was not big enough to make it as a break-even trade. So currently it will still remain as an open trade. We don't have the opportunity to trail onto it as of now. So this will remain as an open trade for us. We'll still track it for the next few sessions and see how this one progresses. The next one is from session number 39. So just give me a second. All right, so this is from session number 39. We did the session on the 12th of October, and the prices came into the zone on the 24th of October. So when we did the analysis, the chart would be something like this. So we did the analysis on 12th of October. So probably this. So when we did the analysis, the chart would look like something like this. So you can always go back and you can watch the recordings if you wish to for session number 39. So when we did the analysis, the chart was like this, and then you can see prices came into the zone, and we immediately got a nice move to the upside. Now talking about how the reward to risk ratio was when the prices were coming inside of the zone, let's double check that. So you can see when the price came into the zone, which was right here, just a second. Wait, it has opened, I think, an incorrect. symbol for us, so I'll have to go back. I have to find this symbol again, so just bear with me for a few more seconds. Okay, it's gonna take me seconds. Perfect. So again, you can see when the prices, they started coming back into the zone. The zone was already tested. This was also tested. I think, yes, we did talk about that our target could have been somewhere around here. So reward to risk ratio was not a challenge. And you can see if I move forward, this is where we entered the zone. So after entering the zone, what happened next? You can see we started moving up. This is the time we started moving up. If I just go to a smaller time frame, you can see that is where we started moving up. So this is the time where we would have got the opportunity to make it as a break-even trade, because that's your 1:1 mark. So the reason I opened this on a smaller time frame is so that you can see that first we went deeper into the zone and then we started moving up, right? Because if the prices would have started from here and we would have made it as a break-even trade, then we would have got an exit. But in this case, we went deeper into the zone, then we started moving up. So we definitely got the opportunity to make it as a break-even trade. And after the opportunity to make it as a break-even trade, what happened next? You can see we again kept moving up, and that is where we are as of now. So what you can see is that we did have an area of supply which now has been violated, and we also have a formation of a new demand area, and that is the time we start trailing our stop loss. You can see something which was at break even. Now our stop loss can be revised to just below this area of demand. So this is where, see, this is how it would be. Initially this was your entry, this was your stop loss. So at 1:1, we would move our stop loss to a break-even point, which will be this break-even. And now we have a violation of this supply area. So since a supply has been violated and we have a formation of a new demand zone, so you can see at the formation of this demand zone, the supply was violated. So now our trailing stop loss can be below this. So the worst case scenario is if the prices, they go down, we still make a small little profit. But if it continues, we'll keep trailing onto it unless and until we reach our target, which is somewhere around here. So yes, a beautiful example where just during the week we got the opportunity to make it as a break-even trade. We also got the opportunity to start trailing onto it. So this will again remain as an open trade, and will track it unless and until we get an exit. But the only difference is that this one is now trailing with a small little profit, right? So we are trailing it with a small little profit on this one. So let's move on to the next. Let's move on to the next one. Give me a second. Let me open the next one now. All right, so the next one is from session number 29, right? Long back. So just give me a minute. Let me find this for you. Yeah. So there we have it. Let me just open it on the screen now. Okay, so this was session number 29. We did the analysis on the 3rd of August, and this was a type 1 trade for us when we did the analysis. And you can see prices came back into the zone on the 28th of October, right? So this is where we came back into the zone. Now, when the prices were coming back into the zone, which is right here, you can see the zone was already tested. You can see had formation of the zone got tested, and then we came into the zone. And after that, we got a small bounce, which gave us an opportunity to make it as a break-even trade. So what would happen is, this is where you will get your entry. Once you reach your 1:1, stop loss gets revised to your break-even point. But after that, prices came back into the zone, and we would have been out of the trade as a break-even trade. So we will close this as a break-even trade, because that's the only opportunity we got on this. We just got a small bounce, and then the trade was shifted to a break-even trade, and eventually you would have been out of the trade. So this one we will close as a break-even trade. So just give me a second. Let me note it down, because I also have to update it in my records. And now we have another one which is pending for review. This also got triggered during the week, and this was from session number 28. So give me a second. Perfect. So this is from session number 28. We did the analysis on the 18th of July. Though it was a type 2 or a type 3 trade for us when the prices, when we did the analysis. So on the 18th of July, when we did the analysis, this was a type 2, type 3 trade for us. Prices came into the zone on the 29th of October. You can see from here, we just capped down into our zone. That is where the prices have been holding for the last few days. But the question is, as a type 2, type 3 trader, would I get the opportunity? Let's verify that on a smaller time frame. So we need a bullish or a very bullish candle completely inside of the zone. Now, the fact is, by the time, this very first candle completed, we were out of the zone. So if the prices are again coming into the zone and you have a formation of a bullish candle, now you're trading a tested zone. But again, depending upon whether you want to be conservative, aggressive, right? As an aggressive trader, I can say still acceptable if you wish to. As a conservative trader, a good idea would be that since the zone has already been tested and we didn't get the opportunity, the best case scenario would be to skip it if you want to be on the conservative side. That is what I would have done. But yes, the zone is still not violated. So we will mark it as no trade, because as a type 2, type 3 trade, we would have not got the opportunity to participate on this. Give me a second. And the other thing which I would also add is that I'm not redoing the analysis. Maybe if we redo the analysis, because this was analyzed long time back, sometime in July. And now we are in almost October. So July, August, September, October, right? So almost after 3 months, we got the opportunity. So things can change. It could have got converted into a type 1 trade, right? But I'm just saving time, not redoing the analysis. So maybe as a type 1 trader, if you had the opportunity to participate, you could have been in the trade. And as of now, the reward to risk ratio is also nice. So in that scenario, maybe this might have been a trade which is still an open trade for us. But like I said, I'm not redoing the analysis. The only reason is I want to save time. So I'm still assuming this as a type 2 or a type 3 trade. But again, you can see the beauty, even if we gap down, for now, the price is stopped exactly where we identified our area of demand. All right. So now that we are done with the reviews of the trades which were getting carried forward, plus we have also reviewed the trades which got triggered during the week, let's get started with our analysis for today. So just give me a minute. Let me bring up the chart, and then we'll start our analysis for today. Perfect. So again, whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. The link is available in the description. So in case you have still not watched that video, do ensure you watch that video, understand the process. There is no bypassing it. Eventually, everyone will have to go through that process. So the sooner you start with the process, the better it is going to be for your trades. But yes, there is no bypassing it. Now, that video will help you understand why you need to be mechanical and rule-based. And since we need to be mechanical and rule-based, we need to create something which is called as a trade plan. Now, the challenge is that when you start learning trading as a fresher, or maybe when you start learning a new methodology, it's not very easy to create a trade plan from day one. And to overcome this challenge, what I've done is I have created a ready-made trade plan for you, which is a combination of 2 documents. And those 2 documents are your trade plan steps. You can also call it as the flowchart or the walkthrough. And the other one is this rule book. And by using these 2 documents, we will learn how to plan trades very mechanically and rule-based using demand supply trading methodology. So what is my step number 1? Step 1 is that we need to define our trade purpose. So now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target. The exit can be break even. The exit can be the trailing stop loss. The exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with my trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So are these a number of time frames? Which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach, and that logical approach is that the longer I want the duration of the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. daily income, a trade which can last for a day or few days, weekly income, a trade which can last for a week or few weeks, and monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so example, if we take the NSE India market, which is not a 24-hour market, I'm pretty sure all of you would have experienced that whenever these markets they open, some of the symbols they gap up and some of the symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24-hour market, we do have that added gap risk which cannot be avoided. So this is why my recommendation to all of you is that initially your hourlies and dailies will be strictly intraday trades, will not be keeping these positions as overnight positions and taking that unnecessary overnight gap risk. Now, when it comes to weekly monthlies, anyhow, we are not anticipating that we'll get the exit the same day. We are anticipating that these can last for a few weeks or maybe even few months. So these are the positions. We'll have no choice, but we'll have to keep them as overnight positions. But that does not mean for weekly monthlies we cannot have a gap against us. It can still happen. But because we are leaning against some bigger time frames, the probability definitely reduces, but it can still happen. So again, initially your hourly dailies will be strictly intraday trades. Weekly monthlies, they will be overnight trades. With experience, with confidence, if you want to include daily incomes into overnight, that can be done, but don't do it early on, right? So again, step one, I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And the answer comes from this table. Now mind this that this table, which is on page number 31, is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, you can use the table which is on page number 32, like your commodities, forex. Let's say if you're trading some international markets, cryptos, right? So this is where maybe even the futures, right? So that is where you can look into this particular table. But since I'll be taking the example from the NSE, I will be referring to the time frames that we have on this particular table. So since I opted, I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if we talk about NSE, on NSE we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to have a process in place which can help me select some scripts out of a very big list. So here we have a very big list of 2000 plus companies. Now I need to have a process for selecting a smaller list. And the more that process is in sync with my trade plan, right, with my methodology, the higher is the probability that I might be able to find something which is qualified based on my trade plan. Now, the fact is, if you do a Google search, you'll be able to find a number of free scanners or screeners, which are either based on conventional technical analysis or fundamental analysis, and they can help you shortlist symbols. But there was no scanner which was based on demand supply trading methodology. So that is where I created two custom built tools. The first one is called as the demand supply zone alerts. The other one is called as the demand supply zone screener. Now, if you want to have a in-depth understanding of how these tools they basically work, we do have the walkthrough videos available. I'll just quickly show you how you can access those walkthrough videos. So what you need to do is that once you're on our website, under services, you have the option for trading view indicators, and here you can see you have the alerts and the screener. So just click on the subscribe now button, and on the product page, you will be able to find the walkthrough videos. But what I'll do is I'll quickly brief you what these tools they basically do so that you have a broad understanding. But yes, for more in-depth understanding, you can watch those walkthrough videos. So talking about alerts, so here is an example of alerts. So as of now, only the crypto market is live. So I'm showing you the alerts using the crypto market. So you can see that here what I've done is I have applied the alerts indicator. And in the settings, I've given a list of about 20 symbols, and these are all cryptos, because alerts, they only work during the live market. And as of now, only the crypto market is live. So that's the reason I'm showing you examples from crypto. So what alerts basically do is you can see that currently I have applied it on a 5-minute chart. So if you have a free trading view account, so just give me a minute. Right, so if you have a free trading view account, what will happen is that you will get a table like this on your chart, and this table will keep getting updated as in when you have a formation of a new demand area or a new supply area. So currently I'm on a 5-minute chart, so it will keep updating every 5 minutes. So you can see the last update is regarding ETH BTC. So if I go to ETH BTC, you can see that we have a formation of a rally base drop, and you can see as soon as this rally base drop was formed, we immediately got to know about it, and that is what we can see here. You can also check the numbers, 0.03 532, 0.03532, and the distal line is 0.03534, 03534. So this is what alerts they basically do, that during the live market, as in when you have a formation of a demand area or a supply area, it will keep updating you. Now, somebody, like I said, who has a free account, you will get this as an update on your chart itself as a table. Now, those of you who have a paid trading view account and you can place your alerts, you will see that you'll also get these notifications like this. And these notifications will keep updating you as and when you have formation of demand and supply area. So it works both ways. For a free account, you will see the updates on the chart. For a paid account, yes, you will have on the chart, plus you will also get the notifications. And in case we get some notifications during the session, I'll show you examples of how the notifications, they also work. So that's your alerts. The other one is the screener. So the way the screener basically works is, again, that in the screener, you'll input your list of symbols. Like you can see, I've given my list of symbols here, and then you need to give your proximity setting. So like here, you can see I've given my proximity setting as 2%. So what I'm telling the indicator now is that out of all these symbols, find the symbols where my current candle is within 2% to a demand area or a supply area. And you can see as of now only on Euro USD, because the first one was this Forex. So what I'll do is I'll just change from Forex to something else. And so let me pick something random and remove Euro USD from here. Let's go down. I'll give this one. So currently you can see I have given a list of about 15 symbols, and not even a single one is getting shortlisted. So just as an example, if I was doing the analysis manually, I had to go through all these 15 symbols just to realize that there is no opportunity where the current market price is closer to a demand area or a supply area. But yes, I would have wasted a lot of time analyzing those 15 symbols. But now, since I'm using this screener, you can see it saved me a lot of time. It basically helped me understand that out of these 15, there is not even a single one. So why do I have to go through all these and do my analysis? So your work is done in just fraction of a second. Now, what I'll do is I'll just increase the number so that maybe we might be able to find something as an example. So from 2%, I'll increase it to 3%. Let's see, do we find something which is within 3% of range? You can see the screener is now telling us that if you look at Kotak Bank will be having a proximity to the supply zone. So if I go to Kotak, you will see that we'll have a supply area, and my current low will be within 3% to it. So you can see if I go from here till here, we are close to that area of supply. So this is how it works. So what it does is it basically helps you identify symbols where you are closer to a demand area or a supply area based on the proximity settings that you provide. All right, so now that we have seen the example, in fact, what I'll also do is, let me change this back to 2%. And what I'll do is I'll just change the time frame. Maybe if not on the daily, do I have something on the weekly? The answer is no. Do I have something on the monthly? You can see on monthly, yes, we are closer to demand areas on some of these symbols. So if I go to SBIN, and here I'll change this to monthly, you can see that we have a monthly chart and we are pretty close to it. See, again, the proximity is, you can see as of now, is getting calculated based on the high and the low. So what it is basically doing is that from this low, I will be within 2%. You can see from here. There you are. The exact one. Okay, I think let's not waste time on this. And you just have a broader understanding. So from this low, we will be within 2% to this area of demand. So that is why it is getting shortlisted for us. So that is how these scanner screeners, they basically work. They help you identify symbols where you are either having a formation. So again, you can see that for the alerts, I just got a notification, and the good thing is before I was able to change the screen, you saw that notification. And if I look at this notification now, what this notification was all about, you can see the notification was that on these particular symbols, you can see from the top to the bottom, we have formation of some demand supply areas. And since I'm back on the 5-minute chart, you will also see this list getting updated in just a few seconds. So now at least you have a brief understanding of how alerts and screener, they basically work. So again, if you want to have more in-depth understanding, you can always watch the walkthrough videos. So once it loads, you will see the table will again be here. So I have to give it some time because the smaller the time frame, the more data it has to analyze. So let's just give it a few more seconds and then we'll proceed ahead. Perfect. So you can see those are the symbols where I'm closer to the areas of demand and supply zones. All right. So again, step number 2, you need to find a smaller list for you. How you find that list, that's completely your choice. The process can be as simple as I just want to analyze the Nifty 50 symbols, or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours how you want to get that list. But once you have that list, we have everything required to start our analysis because we already know our time frames from our step number 1. And now we also know what symbols we'll be analyzing. Now, something very important which you need to understand is that irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols. So scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list which has a higher probability that they might be in sync with your trade plan or with your methodology. So once you have that list, you'll have to analyze them one by one and see whichever matches with your trade plan might be an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's assume the very first one in this list was ABC. So what I need to do now is on ABC, I need to go to the lower time frame to identify zone, and by zone we mean any of these 4 structures. Now, the good news is that when it comes to identifying areas of demand and supply, we also have an indicator on TradingView, which does the process automatically for us. And if you've still not tried this indicator, you can try it for free for 7 days. Now, how do you get access to the indicator for 7 days absolutely free? So what you need to do is on our website under services, go to TradingView indicators. And here you can see the first one is the zone indicator. Click on it and you will be able to find this button which says 7 days free trial. Click on that and then you have this very short form. You have to provide your full name, your email address and your TradingView username. In case you don't have a TradingView account, you can click here. You can create a new TradingView account. And this indicator works on a free TradingView account. So it's not that you need to have a paid account. You can create a free TradingView account. And once you have your account, You can provide your TradingView username here. If you already have a TradingView account, you can click here, visit your profile, identify your correct TradingView username, provide your TradingView username, because if you have provided an incorrect name, it will not get activated for you. It will get activated for the person to whom that TradingView ID belongs. So always ensure that when you're inputting your TradingView username, it has to be correct. Then on which date your trial will expire, you'll get to know at the time of filling the form. And how did you hear about us? You can choose the correct option. Click on I'm not a robot and click on finish and start free trial. So once you fill this form, within 24 hours, it will get activated for you. And once it gets activated, you'll get notification on TradingView itself that now you have access to the indicator, and then you can try it for free for 7 days. And since everyone has that opportunity that you can try the indicator absolutely free for 7 days, whatever analysis we will be doing based on the indicator, because that will help you understand how the indicator works and also how easy it makes the analysis part for us. So let's assume this was the symbol. Just give me a second, please. All right, so let's assume this was the symbol which got shortlisted for us, and we'll start our analysis for this particular symbol. So you can see that we do have a zone which the indicator has already identified for us. And if you talk about the zone, this is a structure of a drop base rally. Now, why is it a structure of drop base rally even though this is a green color candle? See again, let me show you first. In the indicator, you have the option. Let me do this first. I'll say show the pattern name in the zone. So you can see it is telling me it is a drop base rally. Now, why is it calling it as a drop base rally even though it is a green color candle? Because you might say it is a green color candle, so I should call it as a rally base rally. But the thing is, like I always say, demand supply methodology is not based on the color of the candles. It is based on price action. So what is price action telling me? We moved down because this is a bearish candle. So even though it is a green color candle, it's a bearish candle. So we have a drop base rally structure. Now we do have this option in the indicator where you can choose how the indicator identifies the zone for us. So in this example, you can see I have selected that the leg-in method is based on bullish or bearish. So since this is a bearish candle, it is getting marked as a drop base rally. If I say I want the leg-in detection based on the color of the candle, now you will see it will call it as a rally base rally, and the proximal distal will change based on that, right? So again, we have given that option how you want the indicator to identify the zone for you. The default setting is bullish and bearish, not based on the color of the candle. But yes, some people might want to make that modification, so that option is definitely available. But remember, this is a drop base rally. So we'll mark this drop base rally for us. So we have identified the zone. Our step number 3 is done. Now, once you have identified the zone, do we have a zone available? The answer is yes. Now, does not mean that I will trade this zone blindly, and that is the biggest mistake the demand supply traders they do initially. They find any demand area, they try to buy off that demand area. They find any supply area, they try to short using that supply area, which is not correct. You can never blindly buy or sell at any demand zone or any supply zone. Once the zone has been identified, the next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the very first thing we'll check is that the zone we have identified, can it be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is the reason level on top of level is the very first criteria we'll look into. And how do we check that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when you have your intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, the first criteria is my lower time frame zone has to be completely inside my intermediate time frame zone, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level. But if we don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And in this case, our intermediate time frame is weekly. And you can see wherever our lower time frame zone was, exactly there we also have a intermediate time frame zone, which is this one. So what I've done is I have marked the intermediate time frame zone with a different color, which is pink, and the lower time frame zone is marked in green. So whatever I was talking about, you can see currently we have exactly the same scenario, that we have an intermediate time frame zone, and my lower time frame zone is completely inside of that intermediate time frame zone, which makes it as a coinciding level. Now for a level on top of level, we need multiple zones, and it is not mandatory that in case of level on top of level, the other zones might be quality areas. So what I'll do is I'll change the indicator settings to all demand supply structures just to check, do we have only one zone inside of it or do we have multiple zones inside of it? And you can see we just have one zone. We do not have multiple zones, which basically tells me that we only have a case of coinciding level. We don't have a case of level on top of level. And if you have been following my sessions regularly, I'm pretty sure all of you understand that whenever I see such a scenario, I always prefer to use the distal line of the intermediate time frame just to ensure my stop loss is placed at a little safer location. So that is the modification I'll do. So again, it's just a coinciding level. And based on that, I made my modification for the distal line as well because it was coinciding. And now I've also drawn my entry stop and the 1:1s, 2:1s, 3:1s. Just give me a second. All right, perfect. So just a minute. I forgot to make one change, which I need to do really quick. All right, done. Perfect. So yes, we have verified that it's not a case of so can you see this is how, as and when these zones they get formed, you keep getting your notifications. It's not a case of level on top of level, but it was definitely a coinciding level. This zone is not because of a gap, therefore gap rules will not apply. Pivot nor authenticity definitely applicable because it's a drop based rally structure, and to a drop based rally or a rally based drop, we always apply the rules of pivot and nor authenticity. Now, the conservative rule says, the aggressive rule says that the move from the zone should have violated an opposing zone on the intermediate time frame. So this is demand, opposing will be supply. So if we have a violation of supply zone on the intermediate time frame, after the formation of the zone, we will say this is qualified for us based on the aggressive approach. So let's verify that. And you can see that, yes, we did have an area of supply. And when this demand zone was formed and we started moving up, this supply was violated. So as a aggressive trader, if I'm following the aggressive rule, this is definitely qualified for us. But based on the conservative rule, this will not get qualified. Just give me a second again. Why? Because the conservative rule, the very first condition is we need an impulsive move, and currently we don't have an impulsive move. So again, as an aggressive trader, going with the aggressive rules, yes, this is definitely qualified for us. So my pivot nor authentic, yes, it was a case of pivot nor authentic, but it is qualified based on the aggressive approach. Unstable equilibrium not applicable. So after applying all the applicable rules, is it qualified? The answer is yes. But again, I'm following the aggressive rule. Based on the aggressive rule, it is qualified. If you were using the conservative rule, this would not get qualified. Now, the next thing is the boosters. So let's bring up the booster sheet and let's start applying the boosters. Just give me a minute. I don't have the booster sheet loaded. Let me bring up the booster sheet quickly. And I'll need to pick up pace now because I can also see we have a lot of questions today. And we are almost getting closer to the 1 hour mark, which is where I'll have to quickly end the session because then I have to take the Hindi session as well. So let me try to be a little faster now. All right, so going with the boosters, the zone is definitely fresh, gets a score of 3. Time at the, talking about the strength, we have an explosive move. That's the reason the indicator is marking it. Time at the zone, we only have 2 candles, which is again a score of 2. Reward to risk ratio will take as an assumption. Talking about the location, if you look at the monthly chart, we do have the demand area, we don't have supply, and we have covered such scenarios a number of times in the past. So what I'll do is I'll just quickly apply that scenario, and based on that you can see that we are planning our trade low on the curve. So low on the curve is definitely a good location to plan a long trade. So low on the curve gets a score of 1. If you talk about the trend, you can see the indicator is telling us we are in a sideways trend, which is again acceptable because low on the curve, we can trade in an uptrend. We can also trade in a sideways trend. Gets a score of 0.5. Move from the zone, we need at least a 4:1 move, which has not yet happened. So currently it is going to be a score of 0. But eventually prices might move up and then we might start coming into the zone and this might get upgraded. It's not a case of level on top of level. It's definitely a coinciding level. And talking about trap, what I'll say is that as of now, we will have to wait and watch, because if the prices, they go a little higher, if I just take a horizontal line here, and you can see if I start pushing it up, maybe somewhere around here, we have a beautiful area which has been working like support in the past. It has been working like resistance here. So once we go above this, yes, it might work like a trap. Currently, I would like to give it a score of 0. So what will happen is eventually these two might change, which is your trap and also the move from the zone. So currently it is getting qualified as a type 2, type 3 trade only, but just having a move can convert it into a type 1 trade for us, right? So again, based on the arrival, things can change, but as of now, it is a type 2, type 3 trade for us. So going back, currently type 2, type 3 trade. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do our position size calculation. Whenever the prices are back, we'll double check that does it still qualify based on our trade plan. If the answer is yes, we place our order based on the entry type. In this case, currently a type 2 or a type 3 trade. And once your order has been executed, the last step is your trade management, where at 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. And today, when we were doing our review, the session number 39 was a beautiful example where we got the opportunity to make it as a break-even trade, and then also got the opportunity to start trailing onto it. So this is how we plan trades, very mechanically and rule-based. And if these sessions are helping you plan better trades, then do like the video. If you're not subscribed to my channel, do subscribe to it. Plus, if you have any comments, any feedback, you can always put it in the comment section. And last but not the least, I'm pretty sure you people also understand that a lot of people are struggling with trading. So if you have any friends, family members who trade, or if you're part of some trading group, you can always share the link to my courses, the link to these live sessions, links to the trial of the demand and supply zone indicator. So spread the word so that more and more people can take advantage of these free resources that are available. And before we get into the Q&As, I would also like to add that one feedback which we get from you people is, one, that what if I don't want to ask my questions publicly during the live session? What option do I have? Two, what if I want to share my analysis? How can I do that? Because it's not possible during the YouTube live chat. So for that, we have the option for one-to-one appointment. Once you visit our website, on the top right corner, you'll find this button which says one-to-one. And from here, you can always schedule an appointment with me. Two kind of appointments are available. One is voice call. So if you feel that you can just ask your question on a voice call and get answers to your queries, you can go for a voice call. And if you want to share your analysis, then you can go for an online meeting. So those two options are definitely available. But otherwise, if you're comfortable asking your questions during the live session, you can always put it in the chat box and I'll try to answer all the questions before we end the session. So like I said, we only have about few minutes left, so I'll go through the questions, queries very quickly. Thank you for the amazing lessons. I have one question. If I trade the US market and do WIT trades, which should be my lower time frame? Should it be, see, again, it completely depends person to person, but yes, you can see that this table is right here. So if you want to plan WIT trades, you can go for this one, where your lower time frame can be 240. But if you feel that 240 is where you are getting very few opportunities, you want to go to a smaller time frame, then you can even go for this one, because it also depends how many number of trades you expect to take in a week, or let's say in a month. So if you feel your number of trades are going a little low, you can always go to a smaller time frame. But ideally, as a weekly income trader, this is the time frame you should be looking into. All right. Why complete automation always fail in financial market even with supply and demand concepts? See, this is something I have talked about many times in the past. That is that there is no such strategy which can be created as a black box, because the reason is, at the end of the day, with the trading, what is also required is your experience, right? It is not purely mathematics. Now, even if you look at the areas of demand and supply, these indicators they identify for us, I might use one, the other person might use another one based on their personality style, right? One person might be aggressive, the other person might be conservative. Plus, even when the prices they are coming back to the zone, a lot of conditions they change. So, an example which I always give is, in fact, two examples I'll give you. The first one is, let's say, weather forecast. Now you can see the people who do weather forecast, they have supercomputers available to them which does all the mathematical calculation and tell them, okay, this is how the weather can be. But once that computation is done, the results they go to an expert, and then that expert verifies it, and based on his experience he says, okay, yes, we should be putting it out or we should not be putting it out. So what happens is that computers can only do mathematics, right? They don't have experience. Similarly, if you go to an astrologer versus if you're using a software which does astrology for you, most probably an astrologer might give you a better insight versus what a software might be doing. Why? Because again, the software does not have experience. The astrologer has experience, right? So that is why I always say that with trading, creating a black box is a challenge, because software will never have experience. It will only do mathematics, but with trading, you also require experience, and that will give you much better results versus if you're just blindly doing some mathematics and making a algorithm or a black box which is working for you. All right, when we trade on futures on or options chart script, will be trading based on the underlying, is it the demand supply? Yes. So what you're basically saying is that when you want to trade futures or whether you want to trade options, which charts should I be using? For options, always use the underlying. That is what you should be doing. But for futures, if you want to make it easier for you, because in futures at times you can have premium, at times you can have discount. So watching the cash and then taking the futures trade can be a little bit challenging. So if you go right to the futures chart, you will know the exact price where you want to enter your stop loss and your targets. So that can make the process a little easier. So that is something which can definitely be done. But with the options, never the options premium chart. It is always the underlying. All right. Because prices will move based on the underlying. So yes, I've just answered that query. I've applied for the 7 days free trial of the indicator today morning. By when will I get it? See, ideally, you will see within about 10 to 15 minutes, the access gets activated. But generally, we say that the worst case scenario will be within 24 hours. So within 24 hours, it definitely gets activated, provided you have given us the correct TradingView username. So if you have given the correct TradingView username, then I'm pretty sure by now it should have been activated for you. And like I said, it generally happens within 10 to 15 minutes. So you should have the access by now if you fill the form in the morning. If you go to your TradingView notifications, you'll be able to find that you should have received the notification that it has already been activated for you. And just in case it has not been activated, then you would have received an email from us when you fill the form. Just double check you have provided the correct TradingView username. So that could be one reason if it is not still activated for you. Please share a few stocks for this week as per your screener for the learning purpose. See, I'm already sharing it, but the thing is I never provide the name of the symbol, so that is why I'll not be doing it. But yes, when I show you the demo of the screener, if it was shortlisting something for you, you would have got those symbols as an example for you. But unfortunately, today we didn't have a lot of them. All right. How do you play earnings? Do you exit before the earnings or do you hold them especially? See, for me, once I enter the trade, it is always my stop loss or my target or my trailing stop loss. I'm not even watching whether we have the earnings or whether we don't have the earnings. I give news zero importance when it comes to my personal trading. I don't even look into it, right? It's purely based on demand and supply. All right. The session is on recording. Yes, all sessions they get recorded, so you can always watch the recording later. Please give few examples of the trades that came on screener last week and the results on the chart. See, again, all these examples which I'm sharing with you, they are all based on the screener, because I personally use the screener for shortlisting symbols for me. So the last 2 years of recording, if you're going through any of the session, all those were shortlisted by the screener, right? That is how I shortlist my symbols. On your Telegram channel today, 12 p.m. time was given for. See, the 12 p.m. was for the Hindi session. So if you can just go back and check, I do two sessions. 11 a.m. is the English session, 12 p.m. is the Hindi session, and that is what I was telling you, that we have only 4-5 minutes left. Then I have to take the Hindi session, so I might not be able to answer all the questions. I'll try to go through the last few questions very quickly. Okay. So 2 or 3%. See, again, you can always change that percentage. It is not you have to give it as 2 or 3, because if you're trading smaller time frames, right? Let's say you're trading a 5-minute chart, 15-minute chart, then you can't use 2% or a 3%. Then you'll have to go down to maybe 0.5%, maybe 0.25%. So those modifications can be done. So it's not that the screener will only work for 2% or above. Even if you want to give it 0%, now it will identify the symbols where you are already inside of the zone. So choice is yours, what percentage you want to keep. So I'm just showing you as an example. With using 2 and 3, you can make it as small as you want. You can make it as big as you want. All right. Your chart of SBI in 5 minutes, there are a lot of demand and supply areas. Difficult to trade. How to trade this? See, again, yes, whenever we open the chart, there will be a number of demand areas, there will be a number of supply areas, but that is what we are learning, right? How to filter out which zones I need to use and which zones I need to avoid. That is what we have to do. And plus, maybe when you were seeing the chart, I had the option which is all zones. If all zones is enabled, it will show you a lot of demand and supply areas. If you only shift it to quality zones, then it will show you fewer number of demand and supply areas. Okay. Yes, so irrespective whether it is short-term trading, long-term trading, demand supply can be applied to any style of trading, be that intraday, be that swing, be that investing. So it's not that it can only be applied to one particular style of trading. It can be applied to any style of trading. So I know I did go a little fast in the end, but like I told you, I have a session just coming up in about 3 to 4 minutes. So that is why I had to be a little faster with your questions query. So again, I thank you all for joining in. And again, if you have any comments, you can always put it in the comment section. I'll see you now next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye-bye.